Let's play a game of Would You Rather. Would you rather day trade for the rest of your life with one tool or spend the rest of your life trading with hundreds of tools? To me, the answer is pretty clear, but the real question is, can this one tool actually help you become a professional and profitable day trader? Today we're going to go over one of the most deadly concepts that I love to use in the market. And by the end of this video, when you learn exactly what this tool is, you will see things a lot clearly. What we're going to break down today is complex structure, liquidity concepts, weak highs, weak lows, and how we can target things to a precise point in the market. Enter, exit, get our profits, walk away happy. So let's get into the charts. So before we get into the charts, guys, we have a goal to hit 100,000 subscribers by the end of the year. If you haven't already, hit the subscribe button so you could become a professional trader with professional profits. Let's get into it. So the first thing I want to talk to you about is complex structure. Now, the importance of complex structure is a lot of times in the market, people enter off the wrong highs or the wrong lows. I like to enter off protected highs and lows. That way, more than likely, 70 to 80% of the time, the trades I take, that low or high that I'm entering off will not be taken. It's not just a supply or demand zone, but it's complex structure that I understand how to correlate the 4-hour, the daily, the 1 hour, all the way down to the 5-second if need be. That way I can break everything down, take the trades that I like, get in the market and smack some trades. So let me break down this complex structure. As you all know, the easiest simple thing in the financial markets when you first learn how to day trade is higher highs, higher lows. Well, it's never that textbook, and we all know that. So what I want to break down, what I love to break down for traders is what complex structure would look like, because more than likely you'll look at something like this. You'll have a line that's, you know, pretty basic on the daily chart, but then on the 1 hour the daily shows bullishness, but the 1 hour shows bearishness, and you don't know how to correlate the two or what trades to take. So in this example, again, all you need to do when you mapping out is figure out who's in control. The number one thing, well, we know that buyers are in control because we drew our line from the bottom and we starting to trend to the upside. The second thing you need to do is when you're looking at price is look at the highs and the lows. What's being respected? What's being taken advantage of? This is being respected. This is being taken. You know, this is being respected. This is being taken. And then this low is being respected. It did get taken, but again, in the trending market, that's how we're going to look at it. Now, understand that internally, we have things like, you know, we may make a big push on the 1 hour, but then on the 1 hour, we start to show bearishness. Well, one thing that I'm looking at is, hey, where are my supply and demand zones? Where are my ranges of internal, external liquidity, things like that. So for example, something like this, price didn't come all the way down there, but to this demand zone or so, but that's something we would be looking for within that zone. All you want to do is focus on the most previous high and low, or low and high. It's very simple. Once we make a new high, we are now in this range from this low to that high, and then anything outside of that, as you can see, we do take a high here, but then we come down here and take these lows. Well, these lows didn't come all the way down to the discount level. Now this is going to get super complex, but when you take a high and a low really quick, for example, here, you got a low, you got a high. We want to understand that from the top to the bottom, the 618 and 7.708 level are the discount, meaning when you buy a car, you never want to buy it at a premium, high price. You want to buy it at a discount. The same thing factors into price. You never want to buy price way up here, right? You never want to buy it up here when you could buy it down here. So the sense of me showing this complex structure or this low being taken, yeah, you can think you're going bearish, but essentially all we did was come down here and mitigate another demand level that's a little bit lower, a little bit deeper in the discount of this low and this high. Even though this one came down, it actually came to the, let's see, to about the 50%. But this one actually came, as we can see here, from this low to this high, this low to this high here, actually came right here into the deep discount, and we mitigated this level, and then we made a new high, and we go from there. It's the same exact thing on the sell side. We want to understand that all the zigzag in the middle is liquidity, right? Because as you can see, if we go into the details really close here, let's move this out the way. If we go into the details really close here, you see a high, you see a low. Now, when the reason it's complex is because this is our high and this is our low, right? But this high's job is to do what? Take out this low, make a lower low. If sellers are in control, you need to make a lower low. If buyers are in control, you need to make a higher high. Simple, right? So when you actually get this low, This low has a job as well because buyers have the fair value to get in the market. So this low's job is to take out this high. In the event that it cannot take out that high, it becomes liquidity. So when we are looking for entries and stuff like that, we can say, hey, listen, I got a nice level of supply up here somewhere. I want to see what price does. I want to enter off a strong level. This is a strong level because it took a high, took a low, right? That's a strong protected level more than 70-80% of the time. And then what happens is we get all this price action in the middle. Now what people do is they set up a supply zone like this. They try to enter like this, you know, and then they like, oh, I'm about to get this super tight stop loss. Boom, I'm about to target the floor. Price go in their favor. They either break even or they just hold on because they think it's going to fall. It doesn't do its job in taking out this low. If it took out this low, it should be respected, but it didn't. So it becomes liquidity. We come up here, snag the liquidity, the orders, get a bunch of people in the market. Then we get enough sellers to push price down. This is the importance of complex structure. I'm going to show you right now in the real charts how you will look at this. So let's say, for example, right now, our complex structure here. Let's just look at this leg. And it's the only leg we're going to look at for this video. We have a low in the market and then we create a high in the market. Then if we were being technical, we would say, hey, this high took this low. Well, understand that one, we are currently bullish. You know, two, this is not an important low because it's just something at a reaction. The only way this low would be important is if it actually made a new low from that level, but it didn't do that. Actually, let me get this shit out of here. This shit is fucking terrible. That example was ass. Let's go to this. Let's go to this example. So again, we have a sweep of liquidity here. We were moving down. Essentially what we did was, hey, we got a low, we have a high. This high's job is to take out these lows. This low's job is to take out these highs. Why? Because when this low was made right here in this area, this high was the, you know, the strong high. You know, it swept the high, took a low. The moment we took that high, this now becomes a protected low. And once this level takes out that level, it becomes a strong low. So now we know we can enter off of this level. Now in the same case, this high here is a weak high, and the reason it's a weak high is because it did not do its job in taking out this full range of this low here. So now we are sitting between what? 1 and 2. Simple. So now throughout the day when I'm looking to enter, I just say, hey, listen, we had a discount in our price. We can enter off this level. We down here in the dumps. Let's see what we could get. And we could do the same exact thing. Well, we want to enter off a protected low. We want to enter off a low that takes out a high and sweeps some lows. Again, we sweep lows. We take out this high. This is a protected low. Entry number 1 right here on this candle. Protected lows, tight stop loss. You don't need it down here. Put it right there. If you lose, you lose. What can we target? We can target the weak high over time. Why? Because that high did not do its job in taking out this low. So it now becomes and is deemed liquidity. Same thing for other areas in this price action. We have what? A low here, we make a new high, we come respect it. We have a low here, we play around, we respect this level, then we make a new high. Overall, we come back to that level as we can map out here. And we see that we respect that, and then we're off to the races. That is complex structure. That is how you want to see it. That's how you want to factor in strong highs, weak lows, and things like that. I will make it a lot more simple after we go over the next example, which is going to show you and break down exactly what these weak highs and lows are. So in the next example, guys, the simplest way, I know I went over complex structure. I wanted to break that down because if that's something you want to see more of and want me to slow down and make a full video for itself, I will, because I can make it super in depth and help you guys a ton. But let me know down in the comments. Right here we have a high, as you can see. Boom. That high is deemed strong. Why? Because it did what? It did its job. It took out a low. This high, well, let's move this up. Oh, actually, that's right. This low would be deemed a strong low, right? Because it actually took out the high. But one thing that we got to factor in all the time is if we are currently bearish. Why would we take an entry off a strong low that's bullish if we are bearish? Unless we're down here somewhere and we get some price action like this where we start to shift, then we can start to look for those buys. But as you can see, this will be a beautiful level to trade off if we came back to, which I'll show you an example of, to take some sales to the downside, because these levels should now be respected. As you can see here, this level comes up, respects this high, takes a low. This level does what? Comes up, respects this high, takes a low. What do we expect to happen next? Respect this high, take a low. Same thing on the buy side. We have what? These lows here. We take those lows. This is a strong high. We take out that strong high. Now we look at this high, like this low here, like this is an alpha low. We're gonna trade directly off of this. Now, whether you took this trade or this trade right here, it does not matter. But the importance is, the reason why this level got swept was why? Because this low's job was to continue the bullish trend and make a new high. It could not do that. It stopped short. So we take that level. It's liquidity now. We don't want to enter on small trades like mapping out demand and stuff and saying, "Ooh, this is my demand level. I got a reaction." No, you want to get a reaction from, you want to trade off this if you do any risk entries or anything like that. And then if you want to trade off something like this, then your stop loss need to be down here. Or else you get into a position like this where you sweep a low and then we move to the upside. And it's the same exact thing when we get to the complex structure kind of stuff. We still got our low, our high, our low, higher low, lower high, lower low, that kind of thing, right? We do what? We just need to understand that we respect this high right here. Boom, we respect it a little, we might have swept it a little bit, but we respect it. This high did not take out the low, so it becomes liquidity. We take out that high, we take that liquidity, we move to the downside. Same thing here. This high didn't take out the low, this low didn't take out the high. They both get swept. Downside, upside, we enter here and we get in the market. Let me show you an example right quick. Don't want to make this video too long for you. Let me show you an example of me utilizing this right now. So here's a trade I took from today and made some profits on it, but it wasn't the highest quality trade. One, because it was Friday, and two, because we had low volume and the move already happened. It was the only level I knew I could get in and protect myself and follow my plan. But here's a brief and simple example of how a weak low or a weak high can be taken, and then we trade off strong lows and strong highs. So as you can see, we push to the downside here and we push again. And we actually do what? We take out lows all the way over here. We take out some important lows. I love it. Why? Because we enter the market. The market moves here. We, gather some more orders from this imbalance, and then we actually go all the way and we make a strong push to the downside. Me, if you watch my order flow video, then if you haven't watched my order flow video, definitely go watch that because you'll understand why I mapped this out the way I did. Now, as far as my range of supply, I have this. I know when somewhere in this level, sellers kicked in around this price, somewhere here, I don't know, point of interest, and they loved the price that was at and they pushed it down very strong. Now, I could have just said, hey, I want to protect, I like this candle right here, the green, and then we move down. But no, I want to take the full range because at any given time, price can come back to get more orders, as we'll see later. Now, as far as me taking this trade, is very simple. Come up here, we take a low, I'm entering. I'm not even thinking about it. I was like, hey, it might not be the highest quality setup. I wait for price to push a lot stronger, got in somewhere around here, put my stops at the top here, and all I wanted to do was gain a little 1 or 1.5 or so. And that's what we did. Now, if we had a high volume, I would expect price to do what? Take out this low. Why? Because this low did not take out the high. It is weak. Very, very weak. But what price didn't do was, that was a beautiful trade. But when I got out, as I can see now, what price didn't do was take out this low. This high and did not do its job. It didn't take out the low. So in not taking out the low, this high becomes liquidity. If you ever see something like that happen in the trade, get the fuck out. Like real shit. Just get out the trade because more than likely, more than likely, you're gonna get swept. So if it doesn't take this low out, it is now on a weak high. As you can see, we go up here, grab more orders, and then we start to move back to the downside and potentially making a new low, even though the market actually closed. So that's a simple example of one, this low didn't take out the high, so I anticipated it to be taken. In the case that this high I entered on did not take out that low, good thing I got out not being greedy. As I can see, it was moving pretty slow as well once it got down here. It started to chop, but also understanding that now becomes liquidity and we take that high. So these are the levels that people may see and say, hey, oh, this is my next supply zone. I'm going to enter off right here. And then not understanding like, hey, this level here is a weak high. It's a level of liquidity and we don't want to trade off of that. So that was just a brief breakdown of liquidity. I know it's a bit complex. You might need to watch the video 5 times. Just rewatch it, relearn it, drop any questions that you have in the comments, and I will answer them through video or personally reach back out. I answer all the comments, and make sure you drop comments down there because I'm here to help y'all. I'm here to help y'all grow. The importance of liquidity is that it allows you to see what's going on in the market. It allows you to see where the market wants to gravitate. See, the algorithm's job is to gather orders, buyers and sellers. It does not care about all the other stuff, about your trend lines, about your supply and demand zones, about your liquidity levels. But it does care about your liquidity levels. And that's why I'm teaching you these liquidity concepts, because weak highs, weak lows, we can avoid trading from, and we can use as targets, and then strong lows and strong highs, we can actually use those levels to as a confluence to take our trade, be confident, have tighter stop losses, and protect our capital and manage our risk. So with that being said, again, we have a goal to hit 100,000 subscribers by the end of the year. If you haven't yet, hit the subscribe button, hit the like button, so we can reach more people like yourself trying to learn and become a professional trader with professional profits.